Is this thing on or how's it going? Well, hello and how's it going? Well, how's it going?
Hello, and how's it going? Hello, how's it going?
Well, how's it going? Well, how's it going?
Well, no, sorry. Well, how's it going?
Well, how's it going? I'm here with you. I looked at you and I started
I was
laughing.
going to say good.
Well, how's it going? I'm here with Kristian and Madison, and we're back.
We are back.
We're back, baby. My phone vibrated.
Try not to laugh.
Well, how's it going? I'm here with Kristian Karamanich,
Hello, Benjamin.
and I'm going to make the same joke we have for the last 5 or 6 weeks. We're without Madison.
We are without Madison, yes.
She's currently enjoying Europe,
Yes.
where we'd rather be sitting on a
I don't
beach
know if I'd rather be in Macedonia.
in North Macedonia,
Probably a few
eating
places I'd rather be.
cevapis and Greek yogurt and cigarettes.
And Burek.
And burek, sorry. Yeah,
Go on, don't
I
forget.
can't pronounce. I pronounce it like an Aussie. Burek.
It's because you are an Aussie. You're not Masso, so we're not going to hold it against you.
Meat pie. We're off to a good start. Kristian,
Oh, God.
this one's going to be more of a mortgage chat.
Mortgage chat.
Give us a little kickoff. I'm always a little bit spicier on the second episode when we record 2 in a day.
Yeah, I don't know
Yeah.
why that happens, to be honest with you. Well, first and foremost, as always, you've got to plug the show a little bit, so I thought I'd get it out of the way at the start early. Look, if someone asks you, hey, do you know a good real estate agent? You tell them, no, I don't, but there's this great podcast you can listen to instead. It's called How's It Going? It is live on Spotify, on Apple Podcasts, and on YouTube with video on 2 of those platforms. We also have an Instagram page and a Facebook page. Make sure you check us out and refer us to a friend. And answer our Q&As when we post them, please.
Yeah,
We
please
like
do
questions.
that. And if anyone's looking for a date, hit Kristian up as well. He's free most Friday nights and he'll pay for your meal.
I'll be free again as of Friday nights as of this Friday coming.
Oh, okay.
Last 2.5 months I haven't been.
You haven't been. You've been busy.
I teach the children, Ben.
Oh, I forgot.
I teach the children Croatian dancing.
Okay.
Someone's got to do it. But
Yeah.
as a fill-in, as a cover.
Oh,
just while
that's
my
good.
dad's
So you
gone.
get your Fridays back.
I got my Fridays back.
But that means your dad's back.
Yeah, next week.
So the best mortgage broker in the Allura is back.
I can't even respond to that one. You got me. I mean, I'm not going to.
The man that taught you everything you know,
Something like that.
but not everything he knows.
No, there's a lot he doesn't know.
This is
Benny.
getting real bad.
We need to.
Let's
rein
hit the
it back
nitty
in.
gritty.
Let's just rein it back in. Dom, can you mute us for a sec? No. Point of today's episode to what Ben was saying is to give you guys a bit more of a detailed breakdown into how banks actually assess your serviceability, your borrowing capacity. And the main reason is because in my line of work, I get so many people saying to me, I'll come back and give them a number on their borrowing capacity with the repayments. And I'll go, well, hang on, I'm paying more than that now in rent. Why is the bank saying that I can't afford that? How am I surviving otherwise? And usually my response is, it is not a reflection on what you can afford. It is a reflection on what the bank determines they are comfortable lending you. And there's a lot that goes into it. They've got so many weird, wacky, wonderful things built into their servicing algorithms that if you don't know the way they're assessing it, it can be pretty confusing. And so I thought we'd shed a bit of light on that.
Yeah, 100%.
It's inside information into.
I think a lot of people throw around a figure like a borrowing capacity these days, and even myself don't know the ins and outs of how the banks actually get there.
Correct.
And obviously, different banks have different calculations as well.
Exactly right. So the first thing is the big metrics, the really important ones, which are the obviously the big impacts. The first one is assessment rates, also known as sensitivity rates, so it's basically like a buffer. So what the bank does, let's say you're applying for a mortgage and the anticipated interest rate is going to be 5.7%.
Yep.
What a bank will do when they calculate your borrowing capacity in their little servicing sheet, they will not factor in a 5.7% interest rate. They'll actually apply an additional 3% as a sensitivity buffer.
Interesting. So,
Yeah.
if that's what the rate is, then they're assessing you at an 8.7%. So
Correct. So the difference you have on a $500,000 mortgage over 30 years, at a 5.7% interest rate, the actual repayments end up being $2,902 per month. With the added 3% buffer, so assessed at 8.7, the bank is assessing you at $3,916. So $1,000 a month more.
does that buffer differ as for a owner-occupier loan or an investment loan? They just add the buffer as a safe.
Correct.
Yep.
The buffer's a funny thing, right? So back when we had record low 2% interest rates, right?
Yeah.
The buffer at what they actually increased this buffer. It used to be 2%.
So when we were at
if I'm not
2%,
mistaken.
they were only had a 2% buffer.
So what they were doing though, they were applying either the higher of the headline rate plus the buffer, or they had a floor rate.
Okay.
And the floor rate was generally, it still is, they still have this mechanic. There's a floor rate. So that if the interest rate plus the buffer is ever less than their floor rate, they will take the floor rate, so back in the days when we had record low interest rates, all the banks were basically assessing at the same assessment rate because they all had very similar floor rates effectively.
Yeah.
But that's something people don't know about. And $1,000 a month when you're talking about, cash flow, it makes a massive difference. And that's only on a $500,000 mortgage. The average mortgage, I'm pretty sure, is more than that now anyway. So if you've got $1 million mortgage, it's it makes a massive difference. Yeah. There are some instances though, Ben, where the 3% buffer isn't applied. With the major banks, the most common time they don't apply it is with certain refinance policies. So what they do, provided you meet certain criteria, such as usually the most common one is that you're just doing a dollar for dollar refinance with no further cash out or other changes.
Yep.
And what they'll do, if you don't service with the normal 3% buffer, they'll basically assess it with a 1% buffer instead. And the theory behind that is you're already meeting your mortgage repayments at X level. If you refinance and reset your mortgage to 30 years at a lower interest rate, which is why you would do it, your repayments are going to be less. So therefore,
they don't need the buffer if you've shown that you are capable of actually making
correct
a higher rate.
ANZ take it even a step further. You'll find this one quite interesting. ANZ have this policy, they call it a simpler switch refinance, where as a broker, I am not required to provide ANZ with any kind of income verification. I just basically declare the income to ANZ. The only proof I have to give them, the only piece of evidence is obviously ID. That's standard practice. But in terms of serviceability, I just have to prove that the new repayments under ANZ will be lower than their current repayments with their current lender. That's all they assess.
That's an interesting... What a point of difference from them, though, because that makes it so easy as a mortgage broker for you to refinance.
Well, yes and no. The reason they do it, as a bank, they know that we brokers are governed by our aggregators in terms of compliance. So I know how you're thinking. I know how a lot of people think that sounds. It's not a way to cheat the system. It's because as a broker, I can't just declare whatever income I want. Even though ANZ won't verify it, my compliance officers will still want to verify it. I've still got to be able to prove the income that I've declared.
So you mean my ABN that I've had open for a few years, I can't say I cracked $500,000 last year?
Not without proving it to me, Benjamin. No, but the way that it does help is there are certain cases where certain income verification can be very difficult. So the compliance officers, you don't need to meet strict bank requirements for income verification. You just have to prove that the income you've declared there's got to be some kind of proof of what it is.
Yep.
So if you have cases where the income is particularly difficult, like for example, casual income, some banks require you to have a full 12 months worth of accessible income. You can't just give them a payslip and then annualize and be done with it.
Yep.
Even things like bonus income. If you get an annual bonus, ANZ, I believe from memory, their policy is you have to give 2 years worth. It's got to be consistent.
Wow.
Whereas if you use this policy, they're not going to verify it. I can declare whatever I want as long as it meets the compliance officer's verification requirements. It's all good.
That's interesting.
Yeah. So again, the assessment rate buffer 3% is the common practice, but there are certain scenarios and certain ways where it doesn't come into play.
Yep.
What else was I going to have? Currently, I was going to mention the floor rate. I think the floor rate currently is sitting just below 6%. Just for context. So even if we get all the way back down to 3% interest rates, which wouldn't that be nice?
We can hold our breath.
You're still going to have the floor rate, even then still won't come into play. The only time the floor rate will really become a thing again is if we get all the way back down to 2% interest rates, which I don't think anyone can see happening anytime soon.
No, unfortunately.
No. The other metric that the banks use, which is a big one, is something called DTI, which is, what are you smiling at? Debt to income ratio.
I'm trying to be serious here. It's very close to another DT word that I've heard you use in the past.
I actually don't know where you're going with that, but we're going to move on swiftly from that. No, DTI is debt to income ratio. So basically what they do is they take your total debt level, inclusive of all of your debts, not just your mortgage, put it over your annual income, your annual gross income. And then they have a cap for how high that number can be. The generally accepted rule of thumb across the board is 6 is the safety number for banks. A lot of banks will let you go over 6 in certain circumstances. It just depends. So when I say 6, so let's say your mortgage was $600,000.
Yep.
You had no other debts and your annual taxable income was $100,000. Your DTI would therefore be 6. your mortgage over your annual gross income.
Yep.
DTI doesn't generally, so most banks, 6 is like anything under 6, laughing. Between 6 and 8, a lot of them, the majors especially, will still do it, but they sometimes will want to make sure the income you're declaring is, they might be inclined to look into things a bit more closely because they're worried about overexposure.
So you can have further checks instead of if you're 6 or below, you pretty much pass on to the next level.
Yeah, something like that. It depends on the circumstance. The most common time DTI tends to be really high is investment scenarios.
Okay.
Because your borrowing capacity is a lot higher because you've got extra rental income and the negative gearing boosts your borrowing capacity massively. But the negative gearing does not translate into the DTI metric.
Okay.
So your borrowing capacity is very high, but your DTI does not go up with it, if that makes sense. That's not so much an issue now with rates being as high as they are because most people aren't able to borrow that much that it blows out their DTI anymore. But it was a problem at one point back when we were, again, at 2% interest rates because the calculator, the calculator will tell you had X borrowing capacity, but then your DTI was 11. If you submitted it, the bank would decline it on the spot with no hesitation.
Okay.
So that's another important one that a lot of people don't realize. And that's basically, that metric exists so that banks are not overexposing people, which I think is valid, but it's a pretty unilateral metric. Like, it's pretty simplistic. The other most important one, which we harp on about all the time, is LVR. Benny, what does LVR stand for?
Loan to value ratio.
What, you've been listening when I tell LVR. Basically, again, this is so subjective now because there's so many extra policies and programs and promotions where you can sort of get around the standard requirement. But the standard practice with LVR is up to 80%, and the bank deems it as a normal low-risk lend.
Yep.
Anything above 80%, I should probably clarify what I mean when I say 80%. It's quite literally your loan as a percentage of what your property is worth. So if your property is worth $1 million and your loan's at 800,000, 80% is your LVR. And that's where the whole thing about 20% deposit comes in. That's why that exists and why that's the most commonly spoken about phrase when you're buying a house. Do you have a 20% deposit? It's because of this metric. Banks will lend beyond that 80% threshold, but they'll start charging you LMI, lender's mortgage insurance. It sounds nice, doesn't it? Because it's like, insurance. It's not insurance for you. It's insurance for the bank in case you default. And they do that because as soon as they go above 80%, basically some really smart person, however many decades ago, decided that 80% was a very, very safe measure in terms of bank lending. Anything below that, happy days. Anything above that, sound the alarm. And that's basically, so I think I just get on with that. Sorry, Tom. I get really animated when I talk about LVRs. What can I say?
He really put his hand through that table, actually.
LVRs just get me going, man. Anyway, moving on very swiftly from that. Those are all the big metrics, the important ones. Everything else from here on in is kind of just individually in terms of certain income types and expenses and stuff like that. So
from a very broad outlook, though, if you meet that criteria of those 5 dot points, that's pretty much all you do as a mortgage broker. When I send you all my stuff, you just fill out a little form.
I just put it in a calculator.
Oh, perfect.
I don't do anything. I know exactly where he's going with that. I hope you get that.
I was only shit stirring. Kristian works very hard.
Sometimes. This guy.
You were roasting me last time. I'm getting some back.
It's good. Fair. It's, you know what? It's fair. It makes me feel better when you roast me back because I gave it to him last episode. So valid. Treatment of income. In terms of income, base salary is the golden egg.
Yep.
Base salary is basically total for the year. Gross before tax is usually how banks assess it. And they assess it at 100%. There's no extra shaving or weird bank algorithms. It's basically, if this is your base salary, it's evident on your pay slips. Even if sometimes you might have to get a letter or give them an employment contract, it's clear that is your minimum. As long as you are working, that is the minimum you will earn. So there's no shaving or things that come around with it. Overtimes and allowances, those are things that generally get bundled into this category of variable income.
Yep.
Because it's variable because it changes. You generally will not have the same amount of overtime week to week in most jobs, in jobs that do generally have overtime. So the way the banks do it, because it's so inconsistent, it's a little bit different in terms of how it's got to be evidenced. So you've basically got to take a payslip, make sure the payslip depends on the bank, but generally the minimum is at least 3 months year to date. So, we're in the time of the year now where I can't use your year-to-date earnings and just annualize it. Once you get past 3 months in the financial year, if I've got a payslip and it shows me a year-to-date figure, which includes all of your overtimes and allowances, I basically annualize it, deduct your base, and the extra on top of the base, that is what I put in as your variable income. But that gets shaved to 80% by most banks.
Okay.
They don't take all of it because they deem it to be variable. It's not consistent. To give them a bit of a safety buffer, they don't use all of it.
Is that what they would do with someone, for example, like myself's income, commission?
Commission is a whole separate kettle of fish to this as well, just for the record.
I won't take you off topic.
They do generally, we calculate it the same way, generally. But again, commission also, it differs. That one is pretty consistent across the board, the overtimes and allowances with most banks. Commission depends very heavily on the bank. Some banks are very commission friendly, some hate it.
Not so much. So my base salary is $100,000 and I have $20,000 worth of overtimes. Then you're going to be looking at, I'll put myself on the spot there, $16,000. So 80% of that. Yeah. I had to quickly work that out and I
literally had an example on the notes.
Oh, did you?
Yeah.
Oh, yeah, $40,000. Oh, mine was better and I came off top.
Anyway.
And also, who's getting 40 grand in overtime? Like, we don't all work at Blue Scope.
Hey, Dom. Dom works at Blue Scope. You'd be surprised. I've seen pay slips where people's overtimes and allowances are more than their base.
I know you probably can't divulge on it, but like
trades are the big ones.
Okay, yeah.
Trades are the biggest ones that I see it with.
Interesting.
Especially, for example, like people who you get travel and site allowances. So people who might have a job in the state and their boss shifts them out and says, I'll get you a hotel, but I'll also pay you a living on site allowance.
That was the life. I used to get sent to Canberra and I'd get 2 or 3 nights paid in a hotel, meal allowance. They'd give you like a $50 meal allowance. You'd go and get like a $10 dinner and cheer.
Where'd the rest go?
I'm just my pocket.
My wife. Sorry. Anyway, casual income also gets treated the same way, but most banks, you need at least 6 months in the year to be able to annualize it because casual income is deemed to be so inconsistent. Not
always.
Does
that fall under the 80% rule as well?
Generally, no.
No, okay.
It's treated, 3 months it's treated like base salary because it's your sole source of income. It's not extra, but it's harder to evidence. You need more proof to be able to evidence it.
Yeah, so if someone's 6 months worth. Because casual income, generally, I'm thinking it'd be hard to get finance on a casual income, like solely a casual income. If you had a base salary and a lot of people taking on a second job, using that casual income on top,
it can be hard.
But solely a casual income, have you ever had people borrowing solely on a casual? Really?
Yeah.
As an individual?
Yeah. Some banks don't like it. Some banks they won't openly say they won't openly just decline the application solely on that basis. But if that's the sole source of income, it's the sole income stream is casual income, not subsidized by any other forms of income. They don't like it.
Yeah. I can understand
from a lending institution. I get it.
It's very variable.
Yeah. So casual income's a tricky one. But again, the same concept applies. You have at least 6 months year to date on there. Some banks will do it at 3.
Yep.
Take what you've earned over that period, annualize it as your total.
Okay.
Total yearly before tax.
Yep.
Rental income, also shaved, depending on the lender, but usually anywhere between 80 and 90%. So they don't take all the income.
And they're only using income in that part, not gross.
What do you mean?
As in, if I'm getting $20,000 per annum from my rental property minus my costs.
No, the cost that also gets taken into account separately. So they shave. They shave your 20 grand down to 90%, and then they also deduct the expenses later.
Ways. Yep. Yeah. Okay.
And that's because they do that to accommodate for something called vacancy risk. So if you have an investment property, there is a high chance that at some point over a 12-month period, you might have at least a couple of weeks here and there where it's not tenanted.
MMJ North, we are generally under 10 days. Just keep that in mind.
They'll make sure that the vacancy risk is non-existent.
Yep, exactly right.
Bonus income, I did already mention this, but bonus income, for example, if you get it annually, you've got to give at least 2 years worth and it's got to be consistent. Some banks do only, if you get it like a more frequent bonus, like a monthly bonus, for example, some banks will let you do it if you have 6 months worth of bonuses and they're consistent.
Okay.
It depends on, at that one, bonuses is very, very difficult.
Would they annualize it if it was, say, a month? Yeah.
Yeah. But
because that's the whole thing with a bonus. 1 month you could be $1,000, the next month you could be $10,000.
Correct. Bonuses are hard, but I always say to people, if your application is contingent on me using your bonus, if it doesn't work without the bonus, I'll say to them, this is going to be very difficult. Maybe it's worth waiting until we can find another way to do it.
Okay.
If you have to rely heavily on the bonus, it's not great. And the banks don't like that either.
Yeah.
Cool. What else have I got here? Commission, like I mentioned to you, Ben, similar to bonuses.
Oh, sorry. You even had it down there. I'm jumping ahead. Rude of me.
No. Some banks do shade it to 80%, but a lot of them will take it at 100%.
Okay.
Depends on your profession. It's a lot of that's case by case too. Self-employed needs a whole episode of its own. I'm not going to go there. Self-employed is, I could sit here for a whole episode talking about that. Other forms of income, the banks do also take into account things like government benefits, child support, pensions, other investment income aside from rentals. But there's so much differentiation on how it gets taken. Some banks don't take some of them at all. Some heaps of hoops you got to jump through.
What lender takes gambling winnings?
None, Ben.
Okay.
I don't think that's deemed to be, declared taxable income by the ATO.
Yeah. What if you claim it?
I don't know how that works. I'm not gonna fall into that trap.
Okay. All right. I'm not trying to get you in trouble there. I'm just thinking of like there are professional, for example, like card players out there.
Well, like Luca Conte, shout out.
All right. Oh yeah, look.
Come on, guys. Oh God. Okay.
I'm asking the annoying questions.
Yeah, you really are.
Yeah.
But no, you can't use that.
Okay. So if I'm making $100,000 a year from gambling,
the first thing I do is shake your hand and then tell you can't buy a house. The banks won't consider it.
Wow.
It's not considered a valid income stream, realistically.
Fair. But
I think, and again, I'm not going to get myself in trouble. I think from memory, the way the ATO treats it is, I don't think you pay tax on.
Not in this country, no.
Winnings, no. So if you're not paying tax on it, I think that's probably why the banks don't take it, because how do you verify it?
True.
You have no real accurate, consistent way to verify it.
Very true.
Cool. Next up, expenses and liabilities and how they're treated. So most financial liabilities are treated pretty similar to mortgages. The banks have their own assessment rates for them. Existing mortgages are treated the same as new ones, 3% buffer. So if I'm applying for a loan with St. George and I have a previous mortgage with ANZ, I'll have to, it depends on the circumstance. A lot of the banks don't even ask for proof with liabilities anymore because it's all on your credit file. We have something called comprehensive credit reporting. And if the lender who holds the liability is a signatory of CCR, which most of them pretty much are now, you have basically 24 months worth of repayment and conduct history on your credit file automatically.
Okay.
But in some cases, the banks just might want to verify what the interest rate and the repayments are because that's not on the credit file. And if they do, I give St. George a statement showing them what my ANZ mortgage interest rate is, and they'll apply their 3% buffer to that. Same concept with new ones.
Okay.
Credit cards. This is a fun one. I don't care what you have owing on your credit card because the bank doesn't care what you have owing on your credit card. The bank cares what the limit is.
I learned this.
Yeah.
I learned this the hard way.
I only say that because I get a lot of people who say to me, "Oh, but Kristian,
I don't know anything.
I don't know anything.
I pay it off every month."
Doesn't matter. Because the way the banks treat this, unfortunately, it is human nature that you might pay it off 3 years straight, never pay a single cent of interest. Then something happens and you have to use it and it's maxed out. Then you have an active liability and you can do that in a day, the snap of a finger. The banks, to cover their asses and to make sure that you can afford all your debts before they lend to you, they will take the credit card and assume that it is maxed out if it is open. So if you have a credit card that has a limit of 50 grand because it's some whiz-bang Amex or whatever, I don't know, but you've never owed more than $5,000 cumulatively, it doesn't matter. You're getting assessed if you have a 50 grand liability. It can be a big detriment. The way they calculate it, they basically, like I said, they have their own assessment rate. So for example, NAB and ANZ, 3.8% of the total limit per month. The math
on 50,000.
Sure.
Well, let's. I really threw myself on that. On a $10,000 limit, that'd be $380.
Correct.
Yeah,
that's the extra serviceability that they deduct. $380 per month that you have to cover. Personal loans / car loans, they're treated pretty differently lender to lender. Most will just take the actual repayment amount for servicing if you give them proof of what it is. Some do still apply their own servicing buffers as well. Just depends. Well, how's it going? I'm just kidding. We're back from a cut because our camera died on us. So should be back up and running now, we hope. Mr. IT man. Yep, we've got the nod, green light. Cool. I believe I had just finished talking about personal loans / car loans before it cut. Next item on my list in terms of expenses and liabilities was buy now, pay later facilities, so Afterpay and similar. And they're treated the same way as credit cards because they have active limits. They weren't always. Banks for a while struggled to define what they were and how to treat them. But now they've basically landed on, well, it's an active financial liability, so we'll just treat it as if it's always maxed out. You okay over there?
Yeah, I was just seeing how long you realised I was just smiling at the camera.
I'm zooming in on your face when I do these edits later. Next one is HEX. HEX is basically, they treat it as what the actual monthly repayment is based on what gross income you've declared. If you're declaring net income, which some banks let you do, you obviously then don't include HEX because it's already factored in if you take net income. But if you're declaring a gross income, you just deduct whatever the monthly HEX repayment is.
What if you haven't met earning capacity?
Then there is no repayment.
Perfect.
You still put it down as a liability.
Just clarifying that.
Yeah, you still put it down as a
Do they take it
liability.
into consideration as a liability?
You do, yeah, but there's no repayment, so no, not really.
But it has to be known.
Yeah, correct.
Yep.
The other fun thing too, NAB have very recently actually got away with a new policy where if your HEX debt is $20,000 or less, you can ignore it or exclude it from servicing.
That should be illegal. If you go to university, you should be paying the government back.
I think it was 20 grand. I can't remember. There's a threshold where if your HEX is less than a certain amount, you don't have to declare it for bank servicing.
Not fair.
Which is
not fair.
Crazy.
Yep.
All
you people with HEX debt should pay it back immediately.
I don't have a HEX debt. Don't lump me in. I've paid mine off. Yeah.
Well, I said all you people. I didn't.
It sounded very targeted. Yeah, I don't know.
It was just.
I don't. Can you say you people? I don't think that's.
I'm not politically correct anymore. I didn't know we were referring to. Oh, I'm not going there.
We're not going to stop. Stop. Anyway, living expenses. This is a fun one for me to talk about without putting my foot in it. Living expenses are basically taken as the higher of the customer's declared expenses or what they call HEM. HEM stands for Household Expenditure Measure.
I love all these abbreviations in mortgage broking.
There's so many. It's
DTF.
Did you say DTF?
Yeah. I know it's DTI.
DTI. I know. I
got to buy it.
I was trying to clock if you were doing that deliberately or not. It took me a second. My brain's operating on slow. But yeah, a lot of abbreviations.
Yep.
And HEM is basically, so the banks will take, it's a metric they use, which basically relies on data from the Australian Bureau of Statistics, basically. It basically determines a person's minimum discretionary and non-discretionary living expenses indexed quarterly to inflation. So it's basically a case of if you plug your income into a bank calculator, they'll have internal algorithms which determine what your minimum living expenses should be.
So if you declare, the bank's telling me how much I live on.
How much is the minimum you need to survive.
Oh, okay.
It's a funny thing because if you declare less, the bank will go through and you'll have to provide they will scrutinize it heavily, but they'll still take the higher amount anyway.
Yeah.
Whereas if you declare bang on or $50 higher, they ask no further questions. It's really weird.
So everyone knows what it is.
You got to tick. You got to tick the box.
Yeah.
Because the issue is obviously in a lot of cases, if you're young and they adjust it according to if it's not based on how many adults. They'll base it on a married couple with 3 kids versus a married couple with 1 kid. Their expenses will be different, even if their incomes are the same.
Yeah.
So it's very scenario specific.
Do they go through people's bank?
They can. Some banks do it as a matter of
panic about that.
Yeah. Some banks do it as standard practice. You always have to give them at least a month's worth of bank statements. Most of the majors don't, unless there's a reason to.
So they might see little Timmy's withdrawals at the local establishment at 1 a.m. for $300, and what might Westpac think of that?
Well, it's more so what your mortgage broker would think about that, because your mortgage broker will see it first.
Okay.
I'm always on the lookout, guys. Sportsbet doesn't look great either. I've also seen that. And I've had banks pull me up on it. If they see too much of it, they don't like it.
Really?
Yeah.
But they don't know how much I'm winning.
But they also don't know how much you might be losing, Ben. So yeah, living expenses is a funny one. And like I said, I just find it interesting where, especially in the case of younger people, if you're still living at home with your parents, for example, most of the time you're not going to meet the bank's minimums because you've got no set expenses.
Yep.
All of your expenditure is purely discretionary. It's purely fun money. It's, you know what I mean? You can cut it out all out at once if you wanted to. It's not like I don't need to spend, $1,300 at the pub every week to survive. I just do it because I have the money and it's fun. You know what I mean?
Oh, that's a good pub session.
Maybe it's not one single session, Ben.
Oh, sorry. Okay.
Oh, God. But no, and there have been controversies around it too. So Westpac actually got taken to court by ASIC about it. This was years ago now.
Yep.
And Westpac actually won. So basically they went through and said that, Westpac weren't doing enough to verify people's living expenses. And Westpac actually came back and argued, and it was supported by one of the justices, Nye Perham. He made a very famous remark about Wagyu and Shiraz, basically saying that when you take on something as large as a mortgage, as a commitment, your spending habits will change.
Completely agree.
So, if you're living at home with your parents on a rent-free basis with no bills or expenses under your name, you're gonna go out for dinner and get order the Wagyu steak and the expensive bottle of Shiraz because you can. You then buy a mortgage or you have a family or your situation changes. Most rational people will adjust their expenses accordingly.
Yeah.
And Westpac won the case.
That's fair.
On that argument.
I completely agree with that. Like, once you get the mortgage, you go into Macca's and you're getting a mixed smart meal for about $6.
It sounded like a man talking from experience.
Yeah, 100%. $6 for 2 burgers.
That's pretty.
And a plug.
It is a pretty good deal.
Chips and a drink.
Well, yeah, that's basically the argument they made. So living expenses is always a funny thing, guys. So look, and that's part of one of the perks of being able to go through a broker is we can have those extended conversations about it. And you can openly tell me, hey, these are my expenses currently. Most of this is not mandatory. I can cut it out. So can we declare my expenses on the basis of this is what it will be once I buy a house?
Yeah.
Whereas banks generally, if you talk to a bank directly over the phone, whatever you told them on a recorded phone call, they won't unhear it, and you have to then run with that. So if you say one wrong thing, you're screwed.
They take that as gospel. Yeah, I remember that. I filled out the living expenses form the first time we went for a mortgage with the bank and got absolutely smashed.
You get punished.
Yeah.
100%. And it makes a massive difference. So again, that's one of the benefits of talking to a broker is a broker can guide you. And this is not to sound,
dodgy.
Like I said, not trying to put my foot in it here.
Oh, okay.
But it's the truth of the matter is that people's spending habits do change. When you take on a commitment as massive as a mortgage, you will adjust your spending habits accordingly to be able to make sure you can meet that commitment. At least most rational people will.
Most will.
Obviously, there are always exceptions to the rule, but they should not dictate to everybody else how it works.
And keep in mind when you do go to your broker that he's going to see all your transactions. So
correct. I'll see the $300
be worried where you're going to spend your money.
I won't judge. I'm not a judgmental person. I'll only flag it if I think the bank's going to care. Otherwise, I'll keep it to myself. I promise. In terms of living expenses, it's most usual day-to-day items. There are some categories that are taken into account above this, though. So if the bank determines your minimum living expenses as $2,500 per month, that includes majority of your sort of categories, but there are some that are considered above on top, so not incorporated into the HEM. Other basic commitments that are also factored in include things like investment property costs.
Yep.
Remember I said that too. That's going to be taken into account. Rental expense. So if you're renting, that's obviously not part of your basic living expenses. Second property costs, if you have like a holiday home or something. Land tax, things like life insurance, some health insurances like private health insurance, all that kind of stuff.
Yep.
But again, banks have niches with regards to these as well. AMP, for example, they will allow you to include investment property expenses as part of HEM.
Interesting.
Which makes a massive difference for a young home buyer who buys their first property as an investment, but is going to continue living at home with their folks because their basic expenses are probably lower than the bank's determined minimums. If they can also then include their investment property costs in that and not above it, makes a big difference for servicing. So again, lots of different ways they sort of treat it. The other important one, which I will mention very quickly, is notional board. Basically, the bank will not allow me to assume that anyone lives on a rent-free basis. So when I always harp on about that example of, buy an investment, live at home rent-free, I still have to actually factor in a nominal rental expense.
Yep.
So your parents, some banks, a lot of them don't do it anymore. Most of the banks used to require your parents to sign a letter saying you can continue living there on a rent-free basis. So that was stuck. They can never get rid of you. And even then, so even with a letter in writing from your parents saying you can live there rent-free, I still have to include a monthly expense for notional board. And it differs bank to bank. For example, NAB is $500 a month. ANZ is $590. Most of the rest are about $650. Some of them are even higher. I think ING is like $800 and something.
You can rent something pretty good for that.
Per month, not week.
Yeah. We'll find you something.
For $500 a month. I'd hate to see what Ben can scrounge up for $500 a month. Anyway, but my point is, people often, when I fill out their documents and they sign their application forms, they see that and they go, I told you I live rent free. Why are you factoring in this? And I go, because I have to. I don't want to, but I have to. The banks will not allow us to assume that anybody lives, on someone else's dime in this world.
Very rich of them.
They live off our dime.
Exactly right.
Cool. Some other random things that I had, just so we can wrap this up, because this is getting long now too. But just some other minor bits and bobs. Debt apportionment is a very interesting thing. Some banks do it, some banks don't. What that basically is, let's say I'm applying for a mortgage and I have an investment property I own jointly with Ben. But I'm applying for my own mortgage separate now to this one. So I'm buying another property without him. Obviously, when the bank goes to assess my serviceability, they will see that I have an outstanding and existing mortgage liability. Obviously, in my case, if the loan is $600,000, I'm not paying all of it. Ben's paying half. We went halvies on it. So some banks will allow me to basically take and only have to expense half of that debt.
Okay.
Some of the banks that let you apportion it accordingly will require proof that the other person can meet their commitment to their half. So if I go apply for a mortgage and I want to apportion only half the debt, I've got to get Ben to give me some of his pay slips and give it to my bank to say, yeah, Ben can cover his half, only expense half of it.
That's quite a task.
Some banks don't do it at all. Some banks will make me expense the full thing.
Which is going to reduce your borrowing capacity massively.
Massively.
Yeah.
And the funny part is the banks who don't apportion the debt, they still make me apportion the rental income though. So they'll take half the rent that I receive, but they'll expense the entirety of the liability.
They get to have the cake and eat it.
Yeah.
That's cheeky.
Yeah. And it's banks. What do you expect? What else did I have here? Salary sacrifice. People ask me about that all the time. There are certain professions who get really crazy salary packaging deals. A lot of nonprofit people who work for nonprofit organizations, things like nurses, aged care workers, that kind of thing. Those fields allow them to take a certain portion of their income, usually up to a certain cap per year, and it gets deducted from their salary pre-tax, and then they receive it back as rental assistance or mortgage assistance or meals and entertainment cards when they get that income back tax-free. So again, this depends heavily bank to bank. Obviously, it boosts your borrowing capacity massively. If you earn $100,000 a year, but 20 grand of it is tax-free, if I can find a bank who lets me use that 20 grand as tax-free, makes a massive difference to the borrowing capacity. So it's about finding the right bank, because some banks don't let you can take the tax-free income. They'll let you use the whole thing, but you've got to add it back as taxable income. Negative gearing. The big one. This, again, could have its own whole entire episode realistically, but the way banks treat negative gearing is pretty straightforward, actually, which is odd for banks.
Which is odd for negative gearing too, because it's quite complex.
Yeah. Well, basically what they do in a servicing calculator, when I input the details for a loan, be it an existing mortgage or the new one that you're applying for, I usually have a little box that I can tick as to whether it's deductible or not.
Okay.
And what their systems do, I tick the box and it takes the loan amount based on the figures I input, so the loan amount and the interest rate, and it will calculate what the annual interest expense is, and it will then deduct that from your taxable income.
Okay.
For the purpose of because the calculators also internally calculate the tax liability as well.
Yep.
So if you earn $100,000 a year and your tax liability is, I don't know, 25 grand, but then you do negative gearing and the negative gearing brings down your taxable income to 80 grand, it might drop your tax liability from 25 grand to 22. So it gives you an extra 3 grand back in serviceability. It doesn't actually lower the income the bank's calculating. Like, doesn't affect the income portion of their calculators, if it affects the tax component. So it does it all automatically behind the scenes. And it's quite literally just you tick the box, calculates the total interest for the year and deducts that from your taxable income for the purposes of calculating your tax bill. But that makes a massive difference to the overall serviceability, because especially for people if you're sitting on the cusp of a tax bracket. So if you make enough money that you've just broken into a new tax bracket, but then you add on negative gearing, sometimes it can drop you a whole tax bracket. And so your tax bill might affect your tax liability for servicing in a massive way. So it can be a very powerful tool as well. Just so you all know the way the banks calculate it, that one is not complicated. It's basically tick the box, calculate the interest, deduct it from your taxable income.
Most straightforward thing we've spoken about.
I know.
That's good.
I know. That's pretty much everything I had, Benny.
I like it. I like take a few dot points from it, especially the abbreviations, DTI, LVR, DTF. Take all these home, take them into consideration, and
yeah, it's pretty dense. This kind of content is pretty heavy. But I think it's important because, again, I people ask me all the time, and I'm always happy to answer and field the questions, but it's something that a lot of people don't know before they go into it. And if you're
100%,
in some cases, you can shoot yourself in the foot.
Yeah.
Whereas if you know what to keep an eye out for and you know what to expect, it can make it helps you also manage your own expectations.
Yeah. I think it's very good to have a basic understanding of it because, like I said, when buyers especially come to us, it's, this is my borrowing capacity.
Yeah.
They don't know how they got there. 99% of the time, they just sent the bank or their mortgage broker 3 pay slips and they've come up with this magic number.
Correct. And look, I'm guilty of that too, in terms of, I always say to people, I'll show you the calculator. I'll go through it with you if you want. But most people don't care. Most people are like, we trust you. If you tell me this is what it is, this is what it is.
We just want to know how bad we're going to get bent over by the bank.
The answer usually is pretty well.
Viciously.
So it's important to have a basic understanding of how it works. More so just so you're not disappointed.
Yeah.
Like I said, that example I used at the start of oh, we're paying this much in rent. The mortgage we want to apply for is less. How can we not afford it? Why does the bank say we can't afford it? This is why.
Yeah.
And there's obviously a range of factors that come into play there. So,
and I think disappointment is a big part of it because people get in their hopes up that they can borrow X amount, and unfortunately, you're the bearer of bad news in that situation.
Yeah, and it's pretty demoralizing for all parties. A lot of people hear that and they go, "Well, fuck, we're just never going to buy a house then." And it's like it's pretty demoralizing.
And then you're like, "Well, I'm never going to get to write the loan and make a commission.
Never going to get paid.
I'm going to go and jump in front of a car."
That's how big the commission would be.
We always lose, unfortunately.
The only thing, obviously, like I said, we didn't cover in this because I do have intentions to do a full episode on it is self-employed.
Yeah. Okay.
Self-employed income verification is a whole different beast. Like it's and there's been some massive reforms to it the last few years, and it's still massive changes happening there in terms of how they verify it. But basically, it's a lot more complex.
Good idea. We'll save that one for another one.
And we'll do it when Maddie's back so we can watch the gears tick in Maddie's brain when we go through it all. And have someone else to weigh in, not just Ben making snide remarks about DTF abbreviations.
If anyone takes anything out of this, DTF, remember that. Kristian is. On that note,
if I can we get away with that? Do I have to cut that out?
I don't think you have to cut that out. It doesn't mean anything.
BCF and fun.
Yeah. Oh, whoa. I don't know. I don't want to know what you do in private.
BCF and fun. It's a great commercial.
Oh, gosh.
I don't know what you're thinking. I'm just talking about TV commercials.
Yeah, all right, mate. No problems at all.
Keep
the lights on, please.
You need to wrap this up.
With that note.
This is peak brainwave hours. Anyway, Spotify, YouTube, Apple Podcasts.
You led with it. You can't
I'm doing
lead
it again.
and finish with
Why?
it. The people hate us. No, I'm just
anyway. Come on, man. We don't know why they're still watching. No, anyway, point is go subscribe to our socials, go subscribe to the Spotify, to the YouTube. Your support means the world to us. We need it.
Even if it's just one, we appreciate support on one platform.
Absolutely. Yeah. We appreciate it immensely. That's it from me. Do you have any other questions, Ben, or are you?
No, I'm all good. Thank you very much for listening.
Practically a qualified mortgage broker now?
Pretty much.
Yeah, okay, fair enough. Anyway, sorry, wrap us up.
Thank you all for listening and have a lovely rest of your evening, afternoon, or morning.
Yep. Thank you very much and ciao.
Ciao.
Everything presented in this podcast is for information and entertainment purposes only, and all advice is to be considered general in nature. It does not take into account your personal circumstances and financial objectives. Please consider if this advice is right for you and look to consult a financial professional.